Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending January 20th. Let's dive right into the charts and start out with the cryptocurrency asset class, starting with the Bitcoin chart. Bitcoin has been on a pretty bullish tear recently. We were sitting at about 16, 17K just a couple of weeks ago, and now we are all the way back up to about 22.7 or so as of this recording. We did have a pretty significant potential resistance area right around 22.5, 22.6, and so far it looks like it's pushing up through that a bit. But the big key trend line that I'm really watching for is this descending wedge pattern that we've seen ever since we started seeing Bitcoin sell off back in November of 2021. And each time we've reached up to these price levels, we've ultimately sold off. And so we're getting very close to that descending wedge pattern trend line, and we'll need to see how price action reacts from there. My highest probability bet, I think, would be that we'll likely see some resistance there, and that'll probably be the end of this rally, but I'm certainly open to other possibilities, and if we do see price action break above that wedge and we ultimately see price action hold that as support and then move higher, then that would certainly be a pretty bullish development for the cryptocurrency asset class, I think broadly, but also for Bitcoin specifically. We do, however, have another area of resistance right around 25K, which is an anchored VWAP position that has acted as a pretty strong resistance last time we got up there back in August of 22. That also acted as a strong support on the last sell-off when we were above that level back in May of 2022. And so that's another key area of resistance to watch for, right around that 25K level. So if we do see a breakout above that trend line there, then we still do need to contend with that anchored VWAP. But if we break out above that, then it's possible maybe we get all the way back up to about 30K or so in Bitcoin. Not necessarily thinking that's the most high probability outcome, but those would be the next kind of two price targets to the upside if we do see that wedge break, and then be looking at either 25K or 30K for a potential upside breakout if we do break above that wedge pattern. But we still need to get above that first, and we still haven't seen price action develop above those levels, so we'll want to be watching that closely. I would imagine going into this next week we'll likely get an answer as to where price action heads from here, whether we ultimately see a breakout above that wedge pattern, or if we're going to see it act as resistance and ultimately sell off from there. And when we take a look at the Ethereum chart, Ethereum's also had a bit of a breakout. We're sitting at about 1650 right now on Ethereum. We were just at probably 1225 at the lower end of this kind of range-bound price action we've discussed for quite a few months. Also talked about 1400 as a key level to watch for a potential breakout. We definitely got above 1400 again, which is also right around where our 200-day moving average is at. However, we're right now back at the price level where we were previously after the last breakout, which was just about 1670 or so. So a big question going forward will be whether we see a breakout further. Last time we got to those levels was actually where the 200-day moving average was at, and so that acted as resistance, and it ultimately sold off very aggressively from there. This time, obviously, the 200-day moving average has already been broke quite a bit. The 200-day moving average is sitting at about 1400 or so now, so we're well clear of the 200-day moving average now. But the question is, will this price action have some memory and ultimately see potential sell-off from these levels? I think if we do see Bitcoin hit resistance on that wedge pattern, we'll likely see Ethereum roll over as well. And it does look like that we're kind of reaching this level right around 1700 or so, we'd call it, as kind of a key area to see if we're going to break out to the upside further, or if maybe 1700 or so in Ethereum might be the short-term top in the Ethereum price action. And when we take a look at the total cryptocurrency market cap, we've also seen broad participation in all the altcoins as well as Bitcoin and Ethereum. Our total cryptocurrency market cap is fast approaching almost $1 trillion again, which is great to see for cryptocurrency bulls. We are just below that level at about 995 or so, and I would also think probably that 1 trillion price cap could be a pretty strong area of resistance for the entire cryptocurrency asset class. So if we do see the entire cryptocurrency asset class break above the 1 trillion mark and hold that, that would also be pretty bullish for the cryptocurrency space. And then jumping over to the traditional markets, our SPY, SP 500, we had a pretty bullish finish to the week after kind of a lot of volatility. We saw ultimately earlier in the week we got up against this trend line that's acted as resistance now. It looks like about 6 times. And we ultimately had a pretty aggressive sell-off, and so a lot of people went short, including myself, off of that trend line, thinking that could be potentially another big sell-off from here, but ultimately it was just a few days sell-off, and then we rebounded from here. So I closed my shorts off after we got back up below that 390 level on the SPY, and we had a real strong rally on Friday to ultimately get all the way back up to that 200-day moving average. So I think we're going to see some pretty definitive answers here in the S&P 500 in at least the next couple of weeks at the latest. Looks like we've got a pretty decisive turning point here, as we've got both this bottom trend line as well as the top trend line kind of converging here at the latest about mid-February, if not sooner. And we'll ultimately see where price action heads from here. I would suspect that if we see price action break below this bottom trend line, then it'd probably be another opportunity to go short, and we'd likely see markets sell off those levels. Or possibly we might finally see a breakout to the upside off this trend line that's been respected of going all the way back to the beginning of January of 2022. So definitely I think we'll get some really good information in the next week or two out of the broader markets, and specifically the S&P 500. But we kind of need to wait for here. I'm not really looking for any long or short positions in the S&P 500 right now until we really see a definitive break one way or the other, off a breakout or a breakdown off of those levels. But I think we're going to get an answer pretty quickly, and once we do see a break either to the upside or downside, that'll give us a pretty good idea, I think, where the broader markets are heading from here. And then when we take a look at the breadth on the S&P 500, we can see that the number of stocks above their 200-day moving average is, well, it did start declining a bit. We did find a bit of a bottom, and now it's heading back to the upside, sitting at about 62% above their 200-day moving average. And then we also saw the number of stocks on the S&P 500 above their 50-day moving average sell off quite a bit, but we ultimately found support at about that 50% level, which is a pretty key area to watch on our breadth measures. And so the fact that it found that 50% level and then bounced off of it pretty aggressively, finished off the week at about 62, almost 63% of stocks above their 50-day moving average, I think that's a short-term bullish signal as well. And then taking a look at the NASDAQ, or triple Qs, the NASDAQ's also coming up against its trend line resistance. We've touched that level about 1, 2, 3, almost 4 times. 3 where we literally got up and touched the line. A 4th one we just about got there. And then now it looks like we're coming up on potentially a 5th touch on that trend line. So that'll be another key decision point in the NASDAQ. If we can see price action get above that trend line and break resistance and ultimately hold it as support, then that would be a pretty bullish development for NASDAQ. But we're not quite there yet, so still kind of somewhat neutral on NASDAQ as well until we really see a definitive price action reaction off of these levels. So I either want to see a clear breakdown of where that resistance holds, or we want to see a clear breakout where we can see that price action breakout above that trend line. And then we take a look at the Dow Jones Industrial Averages. The Dow has, as we talked about many times, held up much better than the NASDAQ and the S&P 500, so it's been has had the best relative strength out of all the 3 major indices. But we did see a pretty aggressive sell-off once we reached this 343 level on the DIA. But we ultimately saw a pretty nice rebound on Friday on the Dow as well. And so I think ultimately it looks like we're potentially set up for some more bullish price action going into next week. And but we really want to see a clear break above 343 or so, and see that hold if we're looking for any major moves to the upside in the Dow. We've gotten above it a couple of times, but we failed off of those levels pretty quickly. So if we see 2 or 3 days of price action get above that 343 level and hold, then that'd be a pretty bullish development for the Dow. And then take a look at the transports. We've got a descending wedge on the transports as well on the DJT, and we are just up against that trend line once again. Not too long ago we actually did see a break above that level, but then had a pretty big failure and ultimately closed down below those levels on the daily close. So we're once again on Friday back up to those levels, and so next week I think we'll see some answers as to whether or not we can get above those levels. We also have a Fibonacci extension level of 14,360 to contend with. That's a Fibonacci extension level. If we zoom out here, going off of the COVID crash lows and the previous highs before the crash, that Fibonacci extension level has been a key area of both support and resistance for this price action, really going back to 2021. And so we want to see a definitive move out of our price action from these levels and see it break either above or below that point. And it's also converging with this wedge pattern. So if we do see price action break through both of those, that would definitely be a bullish sign for our transports. And then the Russell 3000 chart, we've talked about how significant this Russell 3000 chart is, as when we zoom out, these two trend lines to the upside have been established going all the way back to the Great Financial Crisis. And other than a brief period of less than 2 weeks when we had the COVID crash, we've really seen price action stay within this range, going all the way back to 2008 or so. And so we've got, we're once again up against the top end of this trend line, and we are also up against this 50-week moving average. So if we can see price action break above both that 50-week as well as the down channel trend line, then that would also be a very bullish development for stocks, but we really have not been able to accomplish that yet. We've gone up against this trend line here, it looks like 5 times now. So the big question is the 5th time charm, and is it going to break out, or is it going to ultimately roll over from here? So I think we're seeing on a lot of these charts we're at some very key levels, and I think within the next matter of a week or two we're going to start to get some definitive answers as to whether we're breaking out or breaking down off of a lot of these levels. And then take a look at the IWB, our Russell 1000 for our large caps. Similar story here, descending wedge pattern, coming up against the 50-week, also coming up against this trend line. And if we can see a break up above those levels, then that would be a pretty bullish development for our large caps. And then our small caps have actually, is one of the charts that we're looking at today that's actually already had a fairly definitive breakout. So we ultimately saw small caps break out above this descending wedge pattern, and then we came down and retested it, which oftentimes happens. And then now we've seen a strong push up off of that level, ultimately acting as support, whereas before it was acting as resistance, going all the way back to late 2021. And so that's definitely a bullish development in small caps, and small caps tend to lead the market. And so if we can see small caps especially get up above this anchored VWAP position, which is at about 186 or so, then I think that would even be a further bullish development out of our small caps, and that would also probably be a good signal in the short term for the markets broadly. Then we also see an interesting development out of our growth versus value chart. So when we're going up and to the right, growth is outperforming value, and when we're going down and to the right, value is outperforming growth. And so we can see that since the sell-off started in late 2021, value has been outperforming growth broadly across most time frames. However, we have had 2 pretty major periods of time in 2022 where growth had a pretty significant outperformance over value. And the first one occurred back in March of 2022, and then the next one was in about towards the end of May, early June of 2022. And in both of those cases, that was essentially the signal that we had essentially the best tradable rally in all of 2022. Those were the strongest rallies of the year, and ultimately set us up for some good long opportunities. But we're now, for the 3rd time since the end of 2021, seeing this development where we're seeing a clear breakout in growth above value, and the last 2 times that happened, it was a pretty strong trade signal that we had at least a short-term rally that was a tradable rally, and we could set ourselves up for some long opportunities. So this chart's definitely looking pretty bullish and suggesting we might be set up for a bit of a rally in the market, but we do need to see some breakouts above some of those trend lines that were just coming up and touching on most of those charts we've been discussing today. So if we see those breakouts occur, I think that'll kind of confirm what we're seeing here on the growth breakout, and that'll likely give us a lot of bullish data to go along, at least in the short term in the markets. And I think a lot of people have been positioned bearishly. I certainly was on the defensive side as we entered the year, wanted to see how things started to play out. But at least in the short term, things are looking somewhat constructive and bullish for the markets. I think a lot of that's tied to we're seeing the Chinese market starting to open up, and they're even talking about possible stimulus for their economy. And a lot of times when China's doing some stimulus and having some the reopening trade developing, that oftentimes can support the global markets a bit, at least in the short term. So I think everything we're seeing, especially if we see these breakouts occur over the next week or two, that could be setting us up for a short-term bull market rally for the broader markets. But we do need to be careful, because I think it's pretty certain in my eyes, and from everything I've studied, that we're very likely going to see a pretty steep recession and a sell-off in the markets at some point in this year. But it's setting up where it might take a little while before that develops, and we might actually see some bullish price action to start the year in 2023. And then we're taking a look at our sectors that we review over the last trading week. We can see at the top here we've got a couple of ARC Innovation and ARC FinTech in the leaderboard. FinTech is up 5.6%, Innovation is up 2.8%. Also seeing some strong performance out of oil and gas, 2.5%, as well as cloud computing. Quite a few sectors in the green on the week, but also a decent amount of sectors slightly in the red on the week. Still seeing nat gas just getting beat up. Still haven't found a bottom yet, and natural gas, definitely watching that closely, as I think we are. Each week it keeps selling off even further, so at some point I think we're going to have a really nice trade to the upside, and nat gas is just getting absolutely murdered over the last month or so. But I think nat gas at some point is going to be an excellent trade to the upside. But we've had a very unseasonably warm winter for both Europe and even a lot of parts in America. Other than just a few brief cold spells we've had kind of some unseasonably warm weather, and so that's ultimately, I think, driven the price of natural gas down. But we saw another bad week, down 12, almost 13% in the natural gas fund. Other sectors we saw that had the worst performing sectors on the week, we saw cannabis down 3.3%, utilities down 3.3%, and then also the industrial sector down 3.5%. Industrials tended to be on the leaderboard throughout most of 2022, so it's interesting that we're seeing industrials kind of at the bottom right now, at least to start 2023 out. And then we take a look at our U.S. oil chart. Oil's looking somewhat constructive as well. It's starting to look like potentially it might have put in a bottom, at least in the short term, at the $70 level. However, we have seen price action roll over at this 21-week EMA a few different times, and so that's going to be the real key that I'm looking for going into the next week or so. Is, can we get oil prices back up above that 21-week EMA? And if we can, then that would be a pretty bullish development, especially, and it's not too far from the $85 price level, which is an area of support and resistance as well. So anything above 85, and I think we've got to be pretty bullish on oil prices. But we have seen price action get up above this exponential moving average a few different times, and that was ultimately kind of where it rolled over. So we'll need to see if this is ultimately a short-term top in oil, and maybe we do ultimately roll down and retest that 200-week moving average, which I've been thinking is a possibility. And right now that'd be sending oil down to about 66 or so. So at this point, need to kind of see if there's a clear break above that 85 level to get super bullish on oil prices. Otherwise, I'll be watching for a potential reversal, and maybe we'll ultimately go down and test that 200-week moving average before we see the next big bull run in energy. But we have seen some pretty decent price action in both XLE and XOP. A lot of energy ETFs have been holding up pretty well even throughout this entire sell-off. So when we see oil holding up in the oil stocks, even though we've seen a pretty clear kind of bear market in oil prices ever since about June of last year, I think that's definitely some price information and some signals from that, and it's telling us, I think, that energy is at some point going to have probably another strong rally in 2023. Then we take a look at the CRB index, our commodities, also holding support every time we've gotten down about 265, 267. We've ultimately seen price action move back up to the upside, and so we've really just kind of been moving around in between this 265 level and about 280 or so. So if we can see price action get above 280, I think that would be a bit of a trend change there, and maybe we'll ultimately get back up and retest that 50-week moving average. But for kind of a longer-term bullish setup, I think in commodities we'd want to see price action get back up above that 50-week, which is currently sitting at about 288. And then taking a look at our VEU Global World Index minus the United States, we can see the global markets have been performing really well. It's no surprise with the dollar rolling over. Typically when we have a really strong dollar, it's pretty hard to see any outperformance in emerging markets and global markets abroad, but we've seen the dollar roll over. for the last period of time, and since that's occurred, we've really started to see global markets start to do fairly well. And when we look at it on relative terms, our emerging markets divided by S&P 500, we can also see on this relationship chart here that we bottomed out back in November or so of 2022, and it's really been straight up and to the right for emerging markets relative to the S&P 500. And so I think as long as the dollar is showing weakness, it's looking like there are some decent emerging market trades to pursue, and a lot of those are sitting in China right now. With the Chinese reopening and talk of stimulus, we started to see some bullish price action in a lot of the major Chinese tech stocks and really Chinese stocks broadly. And so I think there is some opportunity to look abroad and outside of the United States, which really has not happened for quite some time. I would argue probably the last time there was really any decent trade setups for emerging markets was going all the way back to May of 2020, and we can see that we had a pretty strong period of time where emerging markets outperformed the S&P 500. And we can also see that the last couple of times we've seen a bit of a rally in emerging markets, we've ultimately got up to about this trend line here and then sold off. And so that's kind of the key area I'm watching for on emerging market trades, is looking to enter some long trades on emerging markets, but we'll be watching closely for that potential peak up at this top trend line, and if we ultimately get up to there, then more likely be closing out any of the emerging market trades as we've historically seen it roll over from that level. And then taking a look at the HYG High Yield Corporate Bond ETF up against our 50-week moving average. We talked about how if we broke above this trend line and this $75 resistance level, that would be a pretty bullish for the markets abroad, and we ultimately saw that occur. Now we're up against this 50-week moving average, and so if we can see the HYG get above the 50-week moving average, I think that would just be an additional bullish signal for the markets broadly. But currently we're sitting slightly below it at about 76 or so on the HYG. And then jumping over to precious metals, gold's been on an absolute tear. It looks to me like gold's probably heading to 186 right now. Was sort of expecting a potential correction earlier, but ultimately we got that correction back in November, and it was a pretty brief one. And we've really been pretty much up and to the right since then, and so gold's been an excellent trade really since it bottomed out in early November of last year. And gold has just been on an absolute tear after really quite a long period of either sideways or declining price action. So I think we're likely going to get up and retest that 186 on the GLD. However, I don't think that's the top end of the move. I think we're just getting started on a much larger bull market in both gold and silver. So very bullish for precious metals in 2023, and it doesn't even look like we're having to wait for that because we already kind of got the start of that rally towards the end of 2022. And I think for most of 2023, there's going to be a lot of great upside trades in the precious metal space, looking at both the metals, precious metals miners, as well as both gold and silver as well. And so that 186 is my next upside price target on the GLD. And then jumping over to silver, looks to me like we're sort of in a bit of a bull flag right now on silver, but we really need to see price action break above about $22.50 an ounce on silver to kind of confirm that bull flag breakout. It hasn't happened yet, and so kind of sitting neutral in silver at the moment. I think there are some more bullish price action in some of the silver miners right now, but on the actual silver price itself, we really want to see price action break above that $22.50 to kind of confirm the next leg higher in silver. And I do think that we'll ultimately get that, but being patient on that one and looking for that $22.50 breakout before I re-enter another long trade for silver. And then taking a look at our interest rates, 2-year interest rates are sitting just below 4.2%. We ultimately hit this 10-day EMA, and it held as resistance. So we'll see if that was the top of this brief rally in the 2-year, if we ultimately head higher from here. But we're still seeing a fairly steady, slow decline in the 2-year, going all the way back to the beginning of November. And then we take a look at our 10-year rates. Similar story. We kind of peaked out late October in our 10-year, and then we've been in a pretty steady decline since then. We've got a pretty nice channel to trade off of here, as long as we're hanging out in between these levels, and I think that gives us some good information to kind of trade off of. So far we've had about 3 touches off the top side of this trend line, and we've got a few touches on the bottom end of this, and so As long as we're not seeing a definitive break above this trend line to the upside, then I think we're still in the opinion that rates are likely heading lower from here. However, they may not be just completely selling off. We might ultimately get some sideways price action in rates, and we could just kind of see a slow, steady decline. I think we still have a few more Fed rate hikes still to deal with, but I do think we're closer to the end than the beginning on those rate hikes, and so I'd be pretty surprised if we ultimately got back up and retested the previous highs, which was about 4.3% on our 10-year. And as long as we are sitting below 3.5, I think it's a really easy trade to the downside. And as long as we're actually below this upside trend line, I think it's also a pretty easy or longer term bet that we're going to continue heading lower from here on the 10-year, currently sitting just below 3.5%. And then taking a look at our 30-year rates, we're sitting at 3.65% on those, just slightly above our 10-day EMA, but still in a medium to longer term downtrend line on our 30-year. And then taking a look at our put-call ratio. So we had a massive spike in put-call ratio this week. It seems like every time we get to some key levels and we see an aggressive sell-off in the markets, everybody buys puts, and so we've seen some record level buying put protection in the markets. Right before the COVID crash, we got up to about 2.9 or so on this put-call ratio chart. Just this last week, we spiked up all the way to about 3.3, so a lot of real defensive positioning and posturing in the markets. Each time we start seeing some potential kind of technical area for a sell-off. And as we talked about just a few days ago, we kind of hit those levels on the S&P 500. You know, everybody's pretty well aware of that trend line resistance on the S&P 500, and so everybody, I think, was positioning for a pretty aggressive sell-off, and ultimately we only saw that for about a day or two. And so we've seen most of that put-buy protection evaporate. Now we're sitting in normalized ranges between 0.5 and 1, sitting at about 0.75 on our put-call ratio. And then talked about the dollar earlier. The dollar chart here we can see has been in a steady decline since September of last year. And it looks like we're probably going to at least get down to 100 or so on the dollar, and we'll see where we go from there. About 100, 100.5 on the DXY has been a very strong area of support and resistance, so that'll be the next level to contend with to the downside. And then we've got this trend line kind of drawing out the steady decline we've seen in the dollar. So if we were to see a break to the upside on the DXY, then that could be signifying that a bottom is in, and we might be seeing a bit of a reversal of the dollar. But for now, the dollar continues to head lower from here, and kind of looking at that $100 level for the next potential area of support. And then when we take a look at our yield curves, we can see the 10s minus 2s are still negatively inverted, about negative 0.69%, and our 10-year minus 3-month is extremely inverted at negative 1.06%. So still very negative readings on both of our yield curve charts. Still, I think, giving us that signal that at some point there is going to be a recession and likely quite a bit of pain in the markets, but they're just not quite here yet. And I think the VIX is a chart that's kind of illustrating that. The VIX, every time we've kind of seen the steady decline after some very elevated levels throughout 2022, every time we essentially had a pretty big rip to the upside from there. We ultimately did move back up from below 20 back to 25, but then it sold off from there, and now we're in what looks like another decline in the VIX, and we're actually below 20 currently to close the week out. And we just a few days ago were quite a bit below 20, almost down to about 18 or so on the VIX, which we hadn't seen a print on the VIX at 18. We have to go all the way back to January of 2022, the last time we were at those levels. And so as long as the VIX is low like this, I don't think there's any cause for concern as far as a massive sell-off in the markets. I think we'd likely need to be well above 25, if not 30, before we start seeing a big sell-off in the markets. And so as long as the VIX is staying at these lower levels, I think that's also supporting the idea that we might see a potential bullish price action in the markets, or at a minimum, at least kind of some sideways price action. And let's go ahead and close it out on the week with a trade setup opportunity on Nugget. So Nugget is a 2x levered fund that is tied to the GDX, so our gold miners. And so gold miners oftentimes create a lot more alpha than the commodity itself. So oftentimes when gold's in a bullish regime, then the gold miners will do well also, but they'll oftentimes perform better returns than the commodity itself. And so I always like looking for opportunities to chase alpha, especially if it's in an area that I'm confident in trading. And Nugget, ticker NUGT, provides that, so we get a 2x return on the gold miners. So the gold miners give you alpha over the gold commodity itself, and the Nugget is giving you additional alpha, double the returns of your GDX. And so definitely provides some nice upside trading opportunities, especially when you're really bullish on gold and gold miners like I am. And so that's definitely a ticker I'll be watching closely for all of 2023 and looking for those trade setups. We are above our 10-day EMA as well as all of our major EMAs, or SMAs rather, the 50-day, 200-day, all those. We've cleared all those major hurdles. And we're also above a key level at about 38 or so on Nugget. And so as long as we're above those levels, I'm staying long for the gold miners space, and definitely think at some point throughout the year that we could potentially be looking at a double from here. I think it may take a while to get there, but it wouldn't surprise me at all. In fact, I'd actually be more surprised if it didn't happen, that at some point in 2023, good chance the GDX will get up to those levels, which on Nugget would represent a price target of about 81, which is almost a doubling from here. So definitely think there's a lot of great upside opportunities trading precious metals this year, and Nugget being a 2x bull for the gold miners just gives you that really big alpha to increase your returns. So definitely check out Nugget if you're looking for a little bit of leveraged upside for the gold miners. So thanks for tuning in, and make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and you can check us out at ToroAlerts.com. We'll see you next week.